morning and welcome to the video for the monthly market update for February. Last week we decided to rebalance the portfolios to take full advantage of market opportunities, repositioning them towards a more risk-orientated position. We're making these changes after considering the results of the 2023 Strategic Asset Allocation Assessment, which highlighted extremely positive long-term expected returns. There will be an event to talk you through this on the 28th of February. Along with this update, you will find a link which will enable you to register for it. For equities, our long-term capital calculation predicted an average of 8% return per year for the next 10 years, improving remarkably from the 10-year expected returns predicted in 2019, 2021 and 2022. What's more, for fixed income, the expected returns are the highest we've seen since we started running the calculations back in 2014. Inflation data has been positive overall in the last 2 months for both UK and the US. Therefore, markets are feeling less pressure from central banks. This week, we saw US inflation data revealed that inflation continued to cool in January, rising at a rate of 6.4%, the lowest rate since October 2021. UK CPI data was also released, and data showed that it slowed to a 4-month low of 10.1% in January, down from 10.5% in December. UK inflation has been cooling since the highs of 11.1% in October 2022, mainly thanks to lower energy price growth, the easing of global supply chain bottlenecks, and a cooling of aggregate demand due to a slowing economy. The short to medium term outlook looks less daunting than it did a few weeks ago. Indeed, the results of the recent earnings season and the general outlook suggest the economy is set to perform better than expected. This makes the soft landing narrative more appealing. Furthermore, the reassuring data on inflation and the attrition of extremely aggressive monetary policy contributed to improving economic situation. Geopolitics still has a role to play on performance, but we see the maintenance of the status quo as the most likely scenario. There will be some disruptions in the energy markets, but these are largely priced in. As a result, we believe that even in a scenario of escalation of the Russia-Ukraine situation, asset prices will be less affected than in the last year. Geographically, we continue to maintain our bias towards the United States and emerging markets compared to Europe. This is because we expect the US and emerging market economies to be more resilient to global challenges. We had long debates about what to do with equities. Developed market economies are holding up fairly well, and that's probably helped risky assets over the last couple of months. But we remain concerned that we'll see more of a slowdown going forwards as the impact of higher interest rates really kicks in. In the end, we concluded that we would like to remain conservatively positioned, but less so than we were in the last year. We remain generally underweight risky assets, so equities, high yield bonds and emerging market debt. We decided that adding to credit, high yields and emerging market debt was the best way to express that view, and we kept our equity exposure slightly underweight in most cases. We increased our exposure to emerging market government bonds for 2 reasons. One, in the short term there's a very strong interest component and default risks are limited and under control. And 2, long-term expected returns are at the highest levels compared to recent years for this asset class. In the coming weeks, we will continue to monitor the situation closely, and we will make further changes if needed. As always, if you have any questions about the rebalancing and what it means for your portfolio, please don't hesitate to get in touch with our advisory team.